The taxability of Social Security benefits is determined by a specific calculation centered on what is called provisional income. To pass the exam, you must master this formula. Provisional income is calculated by taking modified adjusted gross income, or MAGI, and adding 1/2 of the Social Security benefits received for the year. The definition of MAGI for this specific purpose is critical. It starts with adjusted gross income, or AGI, and requires you to add back any tax-exempt interest, like interest from municipal bonds. This is a classic exam trap. The question will list AGI and tax-exempt interest separately, baiting you into using only the AGI figure. You must remember to combine them first. Once you have the provisional income, you compare it to two sets of base amounts that depend on filing status. For single, head of household, or qualifying widow filers, the first base amount is $25,000. For those married filing jointly, it's $32,000. The exam loves to test the exception for those married filing separately who lived with their spouse at any time during the year. Their base amount is 0, which almost guarantees some of their benefits will be taxable. If your provisional income is below these first base amounts, your Social Security benefits are 0% taxable. If it falls between the first base amount and a second higher threshold, then a portion of your benefits becomes taxable. The second thresholds are $34,000 for single filers and $44,000 for joint filers. In this range, the taxable portion of your benefits is the lesser of two amounts, either 50% of your Social Security benefits or 50% of the excess of your provisional income over the first base amount. Let's use an exam-style example. A single taxpayer has an AGI of $28,000 and received $10,000 in Social Security benefits. They have no tax-exempt interest. First, calculate provisional income. It's their AGI of $28,000 plus half their Social Security, which is $5,000. This gives us a provisional income of $33,000. This amount is over the single base amount of $25,000, but under the second threshold of $34,000. So we do the lesser of calculation. We compare 50% of the benefits, which is $5,000, to 50% of the excess over the base amount. The excess is $33,000 minus $25,000, which is $8,000. Half of that is $4,000. The lesser amount is $4,000. So that is the taxable portion of their Social Security benefits. If provisional income exceeds the second thresholds of $34,000 or $44,000, the calculation becomes more complex and up to 85% of the benefits can be taxable. The formula involves 85% of the excess provisional income over the higher threshold plus a fixed amount, but the total can never exceed 85% of the total benefits. For the exam, it's more important to know the thresholds and the maximum percentage. The key takeaway is that once you cross that second line, a significant 85% of your benefits could be subject to tax. Here is a simple way to remember the first tier, which is the most frequently tested calculation. Think of it as the half and half rule. First, you take half your Social Security benefits and add it to your income. Then, if that total is over the limit, the taxable amount is the lesser of half your benefits or half the amount you are over the base. This mental shortcut can save you valuable time and prevent calculation errors on exam day.